Testing. Good afternoon. My name is Dennis Medeiros. I'm the president of UMKC Retirees Association, and I'm glad we were able to get a number of our retirees out here. We're also, I believe, live streaming this at the same time, so that means you've got to be on your best behavior for our camera. Jerry, okay. Before I introduce our speaker today, many of you are aware that we've been conducting a survey of our members and non-members in terms of what they expect from the Retirees Association. I just want to give a final plug to, if you haven't filled out that survey, which just takes about 7 minutes, just click on the survey. It's in the newsletter as well. We have about 125 responses. I like to get up to 150. Mizzou did a survey recently too. We would like to see how we compare there and whether we need to make changes in our structure or activities we do and how to better support our retirees. Having said that, it is my pleasure, first of all, to recognize Bob Pifo. Some of you may remember him as Chair Emeritus, but he's the Chair of the Benefits Committee, and he is the one that has invited our speaker today. Tom Richards is Chief Investment Officer for the University of Missouri, and he has taken time to visit us at UMKC, the Retirees Association in particular, to talk about what he does, the investment. He was telling us at lunchtime the investment portfolio that he handles for the system is $9 billion, and that includes the pension, development, and other activities that he'll go through. He has a handout that should be on your tables there if you want to follow along. We can get you additional ones if you don't have one. So without further comment, I'll turn it over to Tom.
All right. Well, thank you for having me here today. Whenever I come, I always have to remind people that my wife is a UMKC graduate. I almost wore my blue shirt today with the logo on it, but I chose not to. Just going to give an update on the retirement plan, talk about investments, talk about maybe the funded status, which is always of interest, and talk a little bit about some changes to the retirement plan for new employees. So I'll say this several times. Doesn't impact you guys, but I thought you might be interested in knowing what we're doing on that end. And then finally wrapping up with some information about the Fidelity platform. So how many people have 403B or 457 balances that they use Fidelity for? We're going to be making some changes to that, which actually they're good changes, and so I wanted to make sure everyone was updated on that for today. Let's see if I press the right button. So I always like to use this. This is just a picture of the monthly returns of the S&P 500. And if a particular month is up more than 5%, it's shaded in green. If a month is down more than 5%, it's shaded in red. Just to give you a sense of volatility is relatively normal in equity markets. And sometimes, like if, you know, as we all lived through 2008, 2010, there's more volatility than usual. And then at some points we go through periods of very little volatility. Obviously, May was down somewhere around 5%. I didn't have that numbers a couple of days prior to month end. And then we were talking at lunch today about the markets being up quite a bit yesterday when Powell from the Federal Reserve said a few magic words about what the Fed might do with interest rates, and the markets reacted favorably to that. So some of the data I have is as of the end of the fiscal year of 18, because that's the last official data that we have. We'll obviously be updating that at the end of June, at the end of this current fiscal year. But I always like to give a sense of the size of the defined benefit plan and the activity that goes on within the plan. So we started off with about $3.5 billion. The university and employees put in $107 million worth of contributions. We paid out $233 million in benefits, and we ended the fiscal year 18 at almost $3.7 billion, and we're about at that same level at the end of March. So as I always say, the plan's in good shape. One thing that is important to us in terms of how we manage the plan and manage the money is you can see there's more being paid out in benefit payments than is going in contributions. The plan is a mature plan, so we now have sort of a critical mass of retirees, and we've reached the point. This has happened actually over the 8 or 9 years that I've been here. When I was first here at the very beginning, we were still putting in more money than was being paid out in benefits, and that's flipped just because of the age of the retiree population, combined with things like October of 2012, we switched to a hybrid plan for all new employees from that point forward, where they're only getting half the benefits, so then half the amounts being put in. None of this is really relevant to the benefit payments that you get as retirees, doesn't affect that at all, except to the extent that the things that we're doing that I'll talk about, we're doing to strengthen the plan over the longer term, which is protective of your benefits, which are all contractually guaranteed regardless. So we talk about this a lot. A lot of you are interested in this in terms of how is the plan funded, how do we compare with other public pension plans. So this is again data as of the end of fiscal year 18. I would not expect this to have changed a whole lot as we get to the end of fiscal year 19. The investment income is going to be a little challenged this year because of markets. But if we go to the end of FY 18, the total pension liability was $4.4 billion. And so again, think of that as the net present value of all of the payments, of all the monthly benefit payments that we not only have to pay to retirees, but also people like me who are still working. And it's entirely determined by the actuaries and mortality tables and the assumptions of how long each one of us is going to live. So you project that all out, you take the net present value, and that comes out to $4.4 billion. The investments that we have invested, as I said from the previous slide, about 3.7. So that means that our liability, our unfunded amount for the pension plan for the system is about $730 million at the end of FY 18. And I'd expect it to be around there, somewhere around there at the end of 19. So an 83% funded ratio. So how does that compare? That's actually really, really good in the public pension world. And I'll talk about, well, I should mention the assumptions. One point I always like to make at the very top. So the university engages an outside actuary that does a full actuarial study of the plan and again, the participants every year. And that plan or that report from the actuary comes up with an amount of money that the university is supposed to contribute to the plan based on actuarial standards. The university has always funded 100% of whatever that required contribution is. So one of the things that I always like to remind people is if you look at the worst plans, the worst public pension plans in the country, and think Illinois and New Jersey in particular, but certainly they're not the only ones. More often than not, I mean, they have a lot of problems, but usually the biggest problem that they've had is that some years they've chosen just not to make contributions. So if the state's having a budget shortfall or something, they literally have not made contributions, annual contributions into the pension plan. So think about us. That would be like, you know, the university is going through tough times, which actually it has been. It would have been like us saying, you know, we're not going to put that $100 million into the plan because we just can't afford it, and so we'll worry about it later. We've never, ever done that. We've always funded the full amount that's been determined.
What about the contributions from employees? Where does that take into effect? You got university contribution?
Yep.
So that's really not from the university, that's from the employees. Is that not correct?
No, this is probably about 90% roughly from the university and about 10% employees. So all the employee money is going in.
And that's by contract, by actuarial computations.
Yeah, that's included in the actuaries calculations. Okay, the other the other point I want to make with the assumptions, because this is something that was changed within the last year, our assumed rate of return on the pension plan is now 7.2%. When I started here, it was 8%. We got the board to lower it to 7.75. We stood there for several years, and we got the board in this past year to lower it from 7.75 down to 7.2. So that's important for a number of reasons, but one of the things that I'll throw out for any math people, when I talked about the net present value of that arriving at that liability, well, the discount rate is the return assumption. So the higher the investment return assumption you're using, the lower your liability is going to be. So if you're looking at the funded status of a pension plan, you want to see what kind of a discount rate they're using. If they're up somewhere around 7.75 or 8%, it's way too high and the liability is way too low and they're understating the unfunded. Now, could we be lower than 7.2? One could make an argument that we could be lower than 7.2, but the offset to that is when you go from 7.75 to 7.2, this number goes up and this number goes up and then this number goes up. And part of the decision and to end up at the 7.2 was to realistically look at what the budget could support. But if I sum it all up, and again, thinking about relative to peers, in our return assumption, which is pretty reasonable compared to most peers, the 83% funded status is very good in the world of public pensions. Probably, certainly within the top third, I would say, of plans in terms of how well they're funded. So that's the good news, and that's something that we want to continue to build on. Roughly 32,000 members in the plan, so of the people collecting checks.
The inflation assumption is a bit on the low side relative to historical values as well.
It is, but I think there's a lot of reasoning and why that may be the case going forward, why inflation may be lower going forward than it had been in the past. And part of that data feeds off of projections that are done by the Social Security Administration. So yes, it is lower, but it was also thoughtful in terms of why that was changed. Yeah.
Yeah, if we can,
Yeah, I think
for
they-
questions, if we can use the microphone so that people joining via live stream can hear you, it'll be important.
I'm curious about the assumptions that the actuary makes about the population when they project death rates. Is it based upon the average U.S., the average white U.S., the average black U.S., the average female, the average male? What is it?
That's a very good question. I can't tell you the specifics. I'm not an actuary. What I can tell you, though, is that in this last review of all the assumptions, we went to the very latest sort of, they're just called actuarial tables. So whatever the latest set of mortality tables would be used by pension plans with the sort of the latest data, the latest analysis, the latest in trending information, we moved over to that, to the latest set of tables with this last round. I think it's generally, to answer your question, it's inclusive of a broad population. There are subsets of data available in areas and careers more like higher ed, because it can get industry specific, where higher ed people tend to have better mortality, maybe for a number of reasons. There could be a number.
Based on higher education, the higher the education, the longer longevity. That's an excellent point.
Yeah.
It goes hand in hand with the 7.2% return, which I think is way too high. And I kind of agree with Jacob. Inflation estimates probably a little low. And that has serious implications for future well-being and fun. That's an excellent question.
Yeah. Yeah, well, I guess we'll find out with the inflation. I think the one thing that's interesting, or maybe not interesting to you, depending on your perspective, the Fed and all the central banks around the world have been trying really, really hard over the last 8 to 10 years to get the inflation rate up, and they can't do it. And they haven't gotten to a sustained rate of 2%, which is their target. And there's a lot of reasons for that. Who knows beyond the next 10 years, but I think within the near term, the odds of high inflation is somewhat low. In any case, this is a snapshot of where we are, and I wanted to just point that out. And also not hide from the fact that we have an unfunded liability of $730 million. That now with new accounting standards is very transparent. It's on the balance sheet of the university as a liability. This stuff used to be buried in footnotes at the end of the financial statements that no one understood, but now it literally is on the balance sheet and very transparent. This is just to give an example. I talked about that return assumption. This is a sensitivity analysis. So we're using 7.2 and it comes out at 731. If we were using an 8.2, that unfunded liability was 263. If we were really wrong and the number was closer to 6, then this tells us that the unfunded is closer to 1.3 billion. And that's entirely possible.
That's a huge difference.
Yeah, it is. It is. So we're mindful of it, we're monitoring it, and again, we've been trying to get that assumed return down, and we'll continue to look at that. So this is just a quick snapshot of the retirement plan and the allocation. Again, we had a question earlier in terms of the diversification, how we're allocated across the asset classes. I mentioned maybe at lunch that, as an example, equities were down about 5% last month, but we have treasuries and tips in the portfolio, and that part of the portfolio is up maybe 2 to 3%. It's an element of diversification, helps us to manage the risk. But I guess the main point is it's a very diversified portfolio. And to someone had the question also earlier, it's invested across about 125 different investment vehicles or strategies across asset classes. Oh.
I have a question about that. So is this true of just the retirement funds, or is this across the system holdings?
So the endowment pool is very similar to this, and the only difference between the two is that, as an example on the first line item, instead of having 32% of equities, the endowment pool has 35% equities, and it has less treasuries and tips. But other than that, the asset classes are the same and the allocations are basically the same. The general pool, which is the working capital of the university, is invested very differently because the risk sort of profile, the risk needs of that are different than this. So returns, so these returns are as of March 31st. So again, we don't normally report these, but I wanted to be able to give fresh information. We'll have our numbers out June 30th, sometime over August, I would imagine. Equities, you know, it's been a mixed year. And again, this is through, well, so this is through March. So I think April was okay, and then May was down about 5%. So I would expect, but then I have to remember which months are rolling off at the other end of the year, because we've had this roller coaster. We had equities, of course, go up through 2008, then crash near the end of the year, bottomed out about Christmas Eve, and then picked back up and then went back down. A lot of interest in the markets about obviously what the Fed is doing, about China, all kinds of things that we have no control over. Yeah.
How often do you rebalance that?
So these were targets adopted by the board in September of 2017, and we took about 18 months to go from our previous targets to these new targets. We're basically at the new targets that I had laid out here, and they're going to be rebalanced going forward, you know, certainly quarterly. Some of the asset classes are implemented partially or wholly with derivatives, and so they can be rebalanced by sending an email. You don't have any friction on trade costs or anything like that. You know, then we have things like private equity, private real estate, where it is what it is, and you don't have a lot of ability to move that number. Any other questions on the asset allocation or the markets or anything of that nature?
Annually, what sort of variance has there been with the target return versus actual?
Well, that's I'll just go to that, the longer term returns versus what the target is. So again, this is as of March 31st, so this is neither the fiscal year end or the pension year end, which is September 30th. So for the sake of the actuarial calculation, sometimes the cutoff of that year period can have an impact depending on where the volatility is. So I can stand here and tell you that the longer term is important, and we've had a great 10-year run. But what's the problem with the 10-year number? Anyone remember when the markets bottomed out during the financial crisis?
This is all the upswing.
It was in March of 2009. The markets hit bottom, and then they started to go back up. So when we got into, really at this point, actually, this 10-year point has been from the bottom up. So it's great that we have the 10-year return, but if we were looking at an 11-year return, it would be moderated quite a bit by the results of the financial crisis. So, again, this last year period has been very, very choppy in markets, lots of volatility as everyone's trying to settle in on where are we going. I suspect that it might look differently had we reached some kind of an agreement with China on trade. I think the market was expecting that, and that certainly has had an impact on how things have gone. But then again, the Federal Reserve coming out yesterday basically saying that they'll cut rates if they think they need to sustain the markets, which I personally think was a really dumb thing to say. I don't know why they did that, but I'm not on the Fed. But in any case, it is what it is. Okay. Before I get into sort of the changes in new employees, does anyone have any questions that I can answer about your retirement plan, your benefits, anything specific that I can answer while I'm here before I get into sort of these new aspects? Yeah.
I have a question. What triggers a review or consideration of granting a COLA?
Well, it's the unfunded liability. So I think obviously we get that question a lot. The periods of time in the past when we've had the cost of living adjustments have been during periods of time where the plan has been fully funded. And so I think it's difficult to proactively increase the benefit when we're already carrying a $750 million liability on the balance sheet. And the way I like to talk about that, to connect it to reality a little bit more, is that's no different than if we had 30-year debt outstanding. Because we have 30-year debt outstanding in the bond portfolio. And this liability of the pension plan is no different than if we had issued bonds in the marketplace. It's a contractual liability, and we have to make debt service payments on that every year. So when you're in that situation, it's hard to take actions that would cause that number to increase. And then from the perspective of the beneficiaries, you also want to ensure that we're managing the plan prudently and it's as well funded as possible so that there is no question for anyone now or tomorrow in terms of making benefit payments. He had the mic over there.
With 2 years in the Trump administration, with all the political vagaries of that, is that the reason why the 3-year was still looking way better than that 1-year return? Is that a political effect, and would you care to speculate what it will do going forward?
Well, I think certainly the markets have done very well. And so if I can separate out the politics and just look at the policies strictly from a business perspective, taxes were cut and regulation's been reduced. That's very pro-economic growth. So I think a lot of the run-up in equities to me makes sense. But there is a limit to, we're now, I think we're at or very close to the longest economic expansion period in the history of the country So there's a question of how long that can continue. And then there's an argument with things like the tax cuts, whether corporations have really used most of that to buy back the stock, and that's elevated the stock prices. I think that's a fair, argument, but then you can argue whether or not that is in fact a good thing for shareholders. I was at a conference out on the West Coast last week, I think, or the week before, and there was a discussion about sort of maybe a paradigm shift in economic cycles. So this kind of answers your question, maybe. We're used to these sort of repetitive economic cycles of expansion and recession. And there's thinking now, because of the changes and because of how the central banks are more involved in determining what drives the economy, combined with fiscal policy, that maybe the deep cycle and the rapid expansion, maybe at least for the time being, maybe we're not going to experience that. Maybe there'll be more subtle ripples through the market when particular things happen, like a disappointment over a China trade deal, and the market reacts to it. But fundamentally, the economy is fairly sound. There aren't a lot of pressures on private debt. There's not a lot of leverage in the system from the private side, certainly from the public side. But the equity market at the same time can't just keep going up without the earnings growth to support it. And so I find it hard to see a path where that rate of expansion in earnings continues. But not that we couldn't have a continuously good, slow growth economy. And that's not a bad thing, considering the alternatives.
What that does, of course, is a 4.4 actual return. Go back to your 7.2 projection. And what you have just said is maybe we need to go back and look at our 7.2 projection. That may be very unrealistic given the economic trends and situation in hand.
Yeah,
I think that's important to recognize.
Well, I think about that quite often.
Wait till you retire, you think about it a lot.
Yeah. I was at actually a different meeting of peers in higher ed earlier this week, and we were talking about this. A lot of very credible forecasters, investment firms, et cetera, if you look at their prediction of the return on U.S. equities over the next 10 years, it's like 0 to 2%. And that's looking at where valuations are of U.S. equities versus non-U.S. equities. There's a big spread in terms of expectations between U.S. and non-U.S., emerging markets in particular. So strategically, we've decreased somewhat our allocation to U.S. stocks and moved that into non-U.S. and emerging markets. One of the things that I like to think about and throw out, if you look at the size of the Asia-centric economy, so think about anchored by China and the Asian economies around China connected to China. The size of their GDP today is the same size as the United States and Europe combined. Over the last 5 or so years, that area of the economy, that area of the world has grown at about 6% a year. The United States and Europe have averaged about 2%. Those growth differentials are very likely to continue. Something like probably something about, about 85% of the market cap of the stock market globally is in the developed markets. So I guess what I'm saying, to put it another way, you have this Asia-centric economy in the emerging markets. They have about getting close to half of the world's GDP, but in terms of market cap of equities, they're at about 10 to 12%. And then you think about things like China rapidly opening up its markets. So it's something that we're thinking a lot about in terms of where should capital be allocated going forward. The growth is not going to be in the developed world. The growth is going to be in the emerging world, and we're thinking a lot about that. But then you have issues, obviously, about things like investing in China and obviously law, the rule of law in many areas where we wouldn't invest at all. But the reality is the growth is not going to be coming in the Western world, coming from the Western world. So one of many things that we think about. I will say we are now investing in the China stock market. We have China A-shares investments. at a relatively small amount because, again, we think we should be getting into those markets, thinking as long-term investors.
I have a question about the projected rate or discount rate that we use, connected with your comments about the conference you were out at in the rethinking of the business cycle. The analysis you presented sounded scarily to me like what one might have said in 2007. And consequently, it makes me worry a lot about the 7.2 appropriateness as before. And so connected with that, I guess my real question with that as background is how would you talk about the process of making decisions about change, how that has changed? I'm assuming that the curators make the change on the decisions. They are the powers to be, but your office is the primary team that recommends any of those changes. How fast realistically can it be changed if you want to?
Well, I've been working on it for as long as I've been here, which is 9 years now. And again, when I came in, it was at 8. We were able to get the board to go to 7 3/4, and then we sat there for about 5 years. And I will say that the composition of the board right now, I think, is outstanding, and I think they're willing to deal with issues and make decisions. And so this was something, there has to be a willingness to take something like this up. And I would say that the board that we have now and the leadership that we have and the president and CFO were very much willing to take this up and do something, even knowing that the outcome was, and I don't remember the exact numbers, but at least another $10 to $20 million out of the operating budget to go into this. And again, we're in an era of zero-sum game. There is no abundant revenue supply, and so if we have an expense line item that's arbitrarily going up because we change an assumption number, which is what happens, that money has to come from somewhere else, and it means something else is cut. So I think that given the budget challenges that we've had, the willingness of the board to tackle this issue because they felt it was the right thing to do, I think is a good sign. Now again, we could argue, I could argue for a lower number, and we'll continue to look at it, and maybe we'll continue to argue for the lower number, but it's in the context then of I don't want to say easing into it, but even the jump that we took from 7 3/4 to 7.2, that was a really big jump that had a really big impact, and we were willing to do it, which I think is a big deal. So we look at it, we think about it all the time. And it's concerning. But then I'd say, though, I've been talking about this for the last 3 or 4 years at least about being very cautious about return expectations. And over that same time period, we've been up 8.5%. So I've been proven wrong on that. Any other? Okay, I'm going to get into the new retirement plan. So this is just for your information. I don't know if you've heard anything about this yet. This was sort of done in terms of thinking about taking ownership of problems and trying to look for solutions. This was going on in a concurrent path while we were revisiting the assumptions of the defined benefit plan. And what we're in essence doing now, and this has been approved by the board, all new employees, so again, the current state of employees, new employees coming in are in the hybrid plan, half of their benefits DC. So their their DB benefit is roughly half of what you have and what I have. And the other half of their benefit is a defined contribution. Starting, I believe it's going to be on October 1, all new employees going forward will be 100% DC. They'll no longer participate in the defined benefit option. And you might ask why. And I just would go back to, if you're trying to manage the overall financial situation of the university, you go back to that unfunded liability of $750 million. And maybe again, if the return assumption is 6.2, that's a $1.3 billion number. Simplistically, I always kind of would joke with any situation, when you're in a hole, the first step is to stop digging. So we know, and we've had some people think along the way and over the past several years that said we should have done this a long time ago, thinking that doing this will solve all of our issues. It will over a 20-year period, but it's not going to make a whole lot of difference in the near term, because switching over new employees doesn't make that unfunded liability go away. It's still there and we're still going to pay for it, but we're going to prevent that liability from growing. Having said all that, the plan that the board has approved for new employees is actually pretty attractive, and it measures up well in higher ed. So 100% defined contribution. So we're going to start new employees out with an automatic deferral of their own pay of 8%. And the university is going to match that with 8% of pay. The vesting period is going to be the same as it is for the current hybrid over 3 years. And that will get most employees, if they don't change anything, be saving at 16% of their salary. The current best thinking on retirement savings that's needed today for younger people is 15%. So we're trying to get a new plan in place, especially for younger people, where we would set them up from the beginning by saving at an appropriate rate for the retirement. This benefit is, some would say, very generous for the corporate sector. It's pretty much in line with sort of a median range within higher ed of offering that. And the most important thing, again, none of this impacts current retirees or people like me that are still active but are in the defined benefit plan. Anything on that before I go on? Again, I think the transition will be relatively, I don't want to say painless, but it's only going to affect new employees going forward, so no impact on existing employees. And from a new employee's perspective, it remains a fairly generous benefit. Yeah.
Ultimately, when you have a stop to any input into the current plan that our pensions are coming from, there is going to be an end game. Although the number of people that will draw from that will gradually decrease, the amount of money will decrease too. And it becomes a much more risky situation. Isn't that true?
Well, it's more important to manage effectively because you have over time you have one less lever. You don't have the amount of contributions coming in. So yeah, and those would be things that we'd be doing anyway. When we talked about the slide about how we're paying out a lot more in benefits than we are putting contributions in, well then that means that your investment income becomes more important to sustaining the plan, and the volatility of that income becomes more important because you need less volatility to manage it effectively. And then when you think about less volatility, you're taking on less risk. Well, then you have even a lower return expectation, and so it all feeds in. So absolutely, and we're aware of all that. And I would say that obviously we will manage the defined benefit liability prudently, and it's very transparently displayed. It's talked about. It's understood. And this is part of a plan over a longer period of time to make sure that that's sort of managed in the appropriate manner.
Okay, so you have up there that younger people should be saving 15% of their salary. Is there a percentage for people from 65 to 95 that's suggested that we continue to save rather than spend? Does that make sense?
Well,
Say you get to 95
yeah.
and maybe the funding is short from your pension.
I think that's a very personalized question based on any individual's circumstances, their health, their budget in retirement, what they want to do. I think maybe I'd answer it a different way. more broadly, the thing that concerns me about this, which is a problem that already exists today in our society with defined contribution plans, no one has really figured out the good retirement sort of annuitization. Because none of us know how long we're going to live, when you're in a defined benefit plan, that's taken care of through the law of large numbers, and you share the benefit pool. When everyone has a DC balance, then you have to make that decision of how you take that money out. I'd argue that one of the problems, and hopefully maybe the government will address something, for most employers that are what's called ERISA employers, which would be most of the corporate entities, we don't have to comply with ERISA, although we largely do. There are certain sort of safe harbor default investment options in a defined contribution plan. So why do we put new employees into a target date fund? Well, one of the reasons is it's a safe harbor vehicle where the government has said it's a prudent investment. You can default employees in, and you don't have to worry about being sued. Those kinds of protections currently don't exist for things like annuity products within a defined contribution platform. And my personal hope is that there will be a change in regulation that will allow more employers to be going down that path of thinking through how could they, on top of or in combination of a defined contribution plan, offer an annuitization option to employees that would help employees solve that problem. And do it in a way that's more of a group offering rather than you going out and trying to get an individual annuity product, which tends to be pretty expensive with lots of fees. If you could figure out how to do that effectively on an institutional basis, then you're really kind of offloading that mortality risk to the insurance company, which that's what they're in business to do. I mean, that's not an issue specific to us. That's an issue, I think, in our society today with defined contribution plans. Cool.
It's absolutely fascinating to hear you talk from that perspective. Your perspective is 180 degrees out of phase from mine. I'm perfectly capable, as most of us are here, of annuitizing our savings based on actuarial tables. The IRS does it for us with minimum required distributions. But you're talking about legal safe havens. You're not talking about management costs. Most of these target funds have management costs easily 50, 60, 80 basis points. Put your money in Vanguard funds, you're paying 5 basis points. And after 10, 15 years, that is real money. It's just fascinating to hear you talk about legality and safety and annuities, when from our side, those are very expensive options.
Well, I would disagree that there's a my side and an our side. I think there's our side collectively. The issue with annuitization of benefits is a big deal. And we may feel like we're capable of making those decisions, and I have no doubt that you are, but if you think across the broad population of employees that are being asked to make these decisions, it's an issue. And I certainly don't disagree with the fees, we'll talk about that. What we found since from 2012 on, when we started defaulting people into the defined contribution plan as part of the hybrid, 94% of employees have never made a change. So whatever we put them into, they've never changed anything. They've never changed the investment option. They haven't changed their withholding. I think we also have data on how many people have even logged in and looked at what they have. So I think there's an issue about what population you're talking about, but across the broad population, people are not paying attention to this. And that's more of a societal issue. But let me get into the fees, because that's part of a change. Okay. I may get more complex than you want to get into. This is going to be talking about the Fidelity platform. So if you're in a 403B or a 457, if you have money in there, this will impact you. But for the most part, this will impact you in a positive way, because we're being more transparent with fees, and we think we're lowering fees overall across the board. So the first thing I wanted to talk about was Fidelity, as an administrator, as a service provider, is paid to do the work that they do. The cost to support the Fidelity fees has always been paid for by us, the participants. It's just been done in a way that's not transparent, but it's the way it's commonly done across the industry. What I mean by that is, let's say that we're defaulting people into the target date fund. There is a 20 basis point fee that's baked into the target date fund that's taken out of employee accounts, and Fidelity is getting whatever is left over, but the 20 basis points is going back into an account that pays for the Fidelity expenses to administer the plan. So if the target date fund were a 60 basis point or 0.6% expense ratio, what I'm saying is that of that 60 basis points, Fidelity, the management side, the investment management side, is getting 40 basis points, and 20 of that is going into a pool that's helping to pay the Fidelity cost to manage the plan. That's how it's always been done. There are issues with that in terms of, one, not being transparent. So most people have no idea that's going on. They don't realize that they're paying the costs for that. And we think that's wrong because we want to be as transparent as we can be. The other issue that we found is that, like, we do have Vanguard offerings that are on the platform. Vanguard does not share revenue. So there's also an issue of inequality on the platform, in that if you were a younger employee and you had all your money in the Fidelity target date fund, you'd be paying 0.2% a year to cover administrative costs. If you had all your money at Vanguard on the platform, you'd be paying 0. So we've got some employees that are not paying anything and other employees that are paying the cost, and there's no transparency around it at all. So here's what we're going to do. Again, starting in October of 2019, we're moving to what has become a best practices choice, I guess, decision, in that the fee to Fidelity will be charged out on a participant basis, and it will be charged out on a separate line item to each person's account on a quarterly basis. We think it's going to be somewhere around $44 to $46 per employee per year. Now, if you have multiple accounts, so if you have a balance, you have a 403B and you have a 457, it's only charged once per participant. It's not charged per account. What we're then going to do is get rid of the revenue sharing. So that amount that, you know, if you were in a fund and you were paying the 60 basis points and the 20 going out, well, now you'll just be paying 40. Does that make sense? This is something that we're just going to be talking about with employees. So if you had $100 with Fidelity, if I'm thinking through my math right, you'd be paying 60 cents a year in fees. 40 cents would be going to Fidelity Investment Management, and 20 cents would be going to the university HR account that pays the Fidelity administrative bill. Instead of doing it that way now, we're going to charge you, let's say, $44 or $45 a year, and you're just going to be paying 40 cents on your $100 instead of 60. Most people will end up with the fee savings. So if you have, I forget what the threshold balance is, but basically if your balance in the plan is over a certain amount, you're going to come out a net winner. You're actually going to pay less money in fees with that direct charge.
What is revenue sharing here? That's what that's why you lost it.
That's just an industry term of what goes on behind the scenes in the mutual fund business. So if you were, let's say it's not our plan, but you were working with a financial advisor and you maybe were investing through that person, they might be getting a share of those expenses back that you may or may not know about. It's a common practice, and we don't like it on the plan, and we've been talking about this for several years of making this change because we think it's much better to be transparent and let people see what's happening, and then also that enables us to get them the lowest fee that we can. Let's see.
Let's make sure I understand. You're talking about, let's talk about management fees, right?
Right.
Every fund has a management fee. Part of that management fee comes back in revenue sharing. It's not added, revenue sharing is not added on to the fund charge. Is that correct?
Yeah, so if you would look up a particular mutual fund ticker, you go out on Morningstar and it'll show you an expense ratio of 60. For that particular share class, that like usually you'll see several different share classes in a mutual fund. And the reason there are so many share classes to mutual funds is because of things going on like this behind the scenes. And so again, we're trying to get as transparent as we can. Now in terms of the target date funds, I don't know the extent that you're using them, but I'm just going to run through some things, all of which will lead to cost savings. So currently, the Fidelity target date funds that are offered to employees where money is defaulted into, they're entirely actively managed. And the fees on those can be probably from 40 to 60 basis points. We are moving to what Fidelity calls a hybrid target date fund. And basically what they've done is gone through particular asset classes and made decisions where passive investing or index investing would be more effective. So things like U.S. equities, U.S. treasuries. And the effect is the investment mix and the glide path to retirement, all that remains the same, but more of the asset classes will be implemented with index funds. And yet there still are areas like emerging markets, high yield bonds, different asset classes that really are better actively managed. The effect is that the fees for those target date funds will be coming down quite a bit in conjunction with no longer having the revenue sharing. The target date funds is something that we'll continue to look at. We actually looked at, for example, Vanguard, to go to a Vanguard target date fund. There are issues with Vanguard in terms of their retirement glide path and their asset allocation that they use that we weren't really ready to jump to because frankly the Fidelity funds have outperformed them. So we think we're getting kind of the best of both worlds right now and getting a little bit more indexed investing in the target date funds, which will bring the cost down. The other thing we're doing, we're actually going away from Vanguard to Fidelity for index funds because Fidelity is offering us a lower cost.
That's fascinating.
Yeah.
I have a Vanguard index fund through Fidelity, and it's at, I want to say, 7 basis points. So actually, if that is going to get lower.
Yeah. So on the platform today, we have, I think, maybe something like 5 different Vanguard index funds. And in each case, Fidelity's version of that index fund has a lower expense ratio. So we're going to switch over to Fidelity. We're just going to map people. If you're in the Vanguard S&P 500, we're going to map people into the Fidelity equivalent, and the expenses will go down. Fixed income options, we're sort of refreshing those, updating those. We've got PIMCO income replacing PIMCO total return. Public equity options are being refreshed. We're getting rid of some managers that we think just are not compelling in their performance. We're adding an option now for emerging market equity. Not suggesting you consider that in retirement, but for people that are earlier on in their career, again, think about the emerging markets as being an area where most of the growth in the world is occurring. So we're giving employees an option. And the last thing I'd point out for the options, this has been a big deal to employees. We're offering an equity fund now that's kind of geared towards sort of ESG investing or environmental, governance, social, a fund where investment decisions are based on sort of solving the world's problems. We actually had received a lot of pressure. When we redid the plan in 2012, there was a lot of employee feedback saying we want a fund like that in there. We want to be able to invest in something that's socially aware. To be honest, we evaluated lots of options and we couldn't find anything that we were willing to let employee money go into. That's changed a lot. The marketplace is changing. So we're now able to offer with great confidence a manager option for that for employees. So new employee changes don't affect you. The pension plan is in really good shape relative to peers. We still have our challenges. We're being honest and transparent about them. And then the changes of the Fidelity platform, really I would sum up as being increased transparency on fees and lower fees overall. Any questions?
Did you call that an ESG?
That's the acronym that's used in environmental, social, governance. Any other questions I can answer on anything? Almost anything.
Are you being paid enough? You did a really good job today.
You should take a salary cut.
Yeah. I'm always happy to come out and talk about it. It's, it's nice to be a part of the community. I've been here a long time. I'll hopefully be I guess I will be a retiree at some point. I'm in the defined benefit alongside you. My wife has been a university employee since 1999, so she's a defined benefit person as well. Even with the new plan for new employees, it was a difficult decision. And even in doing that, we still wanted to be able to offer new employees a competitive benefit because it's a competitive marketplace. And we're trying to balance the needs of both and maintain sort of intergenerational equity, if you will, across the board. So there are lots of challenges, but I think the best thing that we can do is to be as transparent as we can about what we're facing and what our decisions have been and kind of where we think we're going.
One last question. This kind of asks for an assessment. What do you think the risk is for the university at some point in the future to balk at the quality of our defined benefits plan? Our defined benefits plan is the best I've ever seen pretty much anywhere. I mean, go back, look at IBM, look at what happened to you see all sorts of historical perspectives. The employer just says, we ain't doing that anymore. Suck it up. How would you assess the risk to that sort of an event? Because for us, that'd be catastrophic. Just catastrophic.
I would say it's near zero.
All right.
And I tell you why, just being very transparent. When we looked at shifting over to the new plan, we had the attorneys again go take a look at the existing plan and look at different options because, as an example, I happen to think that the new plan for new employees is very attractive. And there's a part of me that would almost like that for my own reasons rather than a defined benefit plan. One of the questions that we asked the attorneys was, can we give an existing active employee in the defined benefit plan, can we give them the choice to move into the new plan? So we investigated lots of scenarios. At the end of the day, to change our plan would require basically legislative action by the assembly, by the state government.
Well, that doesn't give me a great deal of reassurance.
Well,
Yeah, you don't want them changing,
but you're aligned with lots of constituencies in the teachers and the state employee. I mean, literally, it would require legislative change, and even then, I'm not sure it would be free from legal action. Yeah. No, we looked at that, and in essence, we can't do anything to change the plan or to change the benefits for people that are currently in the plan. So that's when I go back to, and I talked about that $750 million unfunded liability. That's why I really call that debt. It's a contractually guaranteed, mandated by law and contract liability that the university has to its employees and retirees. And so that also means that we need to manage it as if it's a real debt and not some number that's hidden in the footnotes in the back of a financial statement. So we're thinking about it very carefully, want to make the right decisions. Your benefits are in good shape, and they're contractually guaranteed, but they're also backed by a good investment pool that's well funded. So thank you for having me, and I'm always happy to come back. And if you don't like it, it's Bob's fault.